The price is lying and the spread is telling the truth. And that's exactly why the Fed's tiny liquidity move is a bigger alarm than most people realize. Because the fight right now isn't just bulls versus bears, it's the real market versus the paper market. It's physical demand quietly tightening the screws while the headline price tries to act calm. And if you stay with me to the end, I'm going to give you the only two scenarios that matter for the next 1 to 2 weeks. The key levels that decide which scenario wins, what would invalidate this whole setup, and the one metric you should watch first before you even look at spot silver. Here was the first trap. People are obsessing over a number like Fed injects $3 billion as if it's either a bailout or nothing. But in the plumbing world, the number isn't the headline. The behavior is the headline. The Fed doesn't have to scream QE for the market to feel it. It just has to open a valve because somebody, somewhere, couldn't get cash at a price they were comfortable paying. And that's where the real pressure starts. Let's translate it into market structure, not vibes. The Standing Repo Facility, SRF, is basically a standing offer from the Fed to lend cash overnight against high-quality collateral like treasuries and agency MBS. It's supposed to put a ceiling on overnight funding rates. In a smooth system, it barely gets used. Not because it doesn't work, because if private funding is abundant, you don't need the Fed's backstop. So when you see meaningful take-up, especially into calendar stress, you don't wave it off as technical. You ask the only question that matters. Why did the private market stop being comfortable at the margin? And the timing right now is not random. This week is the rollover window. Year-end had just passed. Balance sheets get guarded. Liquidity gets thin. Dealers and banks manage capital constraints and window dressing. Money funds shuffle. Repo books get careful. And when that happens, rates can spike even if the world isn't in crisis. That is the part the mainstream always misses. You can have a non-crisis that still forces emergency behavior. Now, here's the detail that changes the entire tone of this story. At year-end, the SRF wasn't just used, it was used at record size. That's not a conspiracy, that's a measurable fact. We're talking tens of billions in take-up on the final trading day of the year, alongside a surge in reverse repo usage where cash gets parked back at the Fed. Two big flows in opposite directions at the same time, that's not nothing. That's institutions acting like liquidity is precious. And when liquidity is precious, hard assets don't wait for permission to reprice. Because metals don't trade in a vacuum. They trade inside a system that lives on collateral, leverage, and confidence. And right now, confidence is being quietly rationed. Here's why that connects directly to silver today, this week, this month. Silver isn't just an inflation hedge. Silver is a leveraged market structure. It's a metal with dual demand. It's financial when people want protection, and it's industrial when supply chains are stressed. And when both pressures hit together, silver doesn't glide. It snaps. That's why the word emergency keeps showing up around metals right now. Not because the world is ending. Because when funding markets tighten and the calendar is dangerous, the paper market becomes more fragile at the exact moment physical demand gets less flexible. And that combination is gasoline. Now let's talk about the China piece, because this is where the story gets misread on both sides. On one side, you'll hear, China is vacuuming up 41 tons. On the other side, you'll hear, that number is exaggerated, or Hong Kong data doesn't show it, or retail demand in China is weak. And here's the truth. All three can be partially true, and the signal can still be screaming. China's gold flows are lumpy and multi-channel. Hong Kong is one window. Shanghai and Beijing are other windows. And the key isn't the exact round number someone tweets. The key is the pattern. When you see net imports via major conduits jump to levels that are measured in the tens of tons, when you see months where net imports spike into the 40-ton neighborhood, and when you see continued official sector accumulation alongside it, you're not watching a normal buy-the-dip retail behavior. You're watching strategic inventory behavior. And that's the part that matters. Because strategic buyers don't buy like tourists. They buy like engineers. They don't care about your RSI. They care about supply certainty, currency risk, and the long-run role of metal as collateral outside someone else's liability. So even if one month is 16 tons a net through one conduit and another month is 40 plus tons net through that same conduit, and you know it's incomplete because other channels exist, the correct conclusion isn't the number is wrong. The correct conclusion is China is still present in size, and size at the margin sets the tone for global price discovery. And that's where the setup flips. Now, why does gold matter in a video that's supposed to expose silver manipulation? Because gold is the macro anchor. Silver is the lever. Gold is the message. Trust is leaking. Silver is the mechanism. Leverage turns that message into violence. And the violence doesn't show up first in the headline price. It shows up in the structure. Here's the hidden detail I promised. The one most people miss. If you want to know whether silver is being artificially cooled, stop staring at the spot quote like it's sacred. Spot is a print, structure is a diagnosis, structure is the spread. Proof point 5, industrial dependence makes silver uniquely vulnerable to procurement panic. Solar and electrification are not nice-to-have trends. They are policy-backed, capital-backed, and increasingly strategic. When you get a price spike, manufacturers don't suddenly stop needing silver next month. They start trying to secure it. Proof point 6, the behavior of paper, markets under stress, margin tightening, volatility expansion, dealer hedging, can create violent wicks that shake out weak hands without changing the underlying tightness. That's a proof stack, not a single story, a stack. Now the question becomes, where is the hidden signal that tells you whether this is a blow-off top or a structural squeeze that's just getting started? And here it is, the spread. When people say the price is manipulated, what they usually mean is the spot quote doesn't match what my gut says about scarcity. But guts don't clear markets, spreads do. Watch the near-term premium behavior. Watch how quickly dips get bought. Watch whether the market rewards immediate delivery relative to later delivery. Watch whether the forward curve tightens even when the headline price gets slapped. Because if the curve stays tight, it means the physical market is still bidding. And if the physical market is still bidding, paper dips can turn into short-lived events rather than trend reversals. And that's where the real pressure starts. Now let's talk about the Fed panic, framing carefully, because credibility matters. Was a few billion in a daily operation the end of the world? No. But does the presence of emergency plumbing tools being used aggressively into the calendar at record levels tell you the system is not as loose as people assume? Yes. And does that matter for silver? More than almost anything else, because silver is not priced in a calm world. It is priced in a leveraged world. In a leveraged world, the cost of money and the availability of cash are as important as supply and demand. Here's the part that flips the whole setup. If funding stress persists, even mildly, into a market that S already stretched, you can get both outcomes faster. You can get faster liquidations on downdrafts and faster squeezes on upthrusts. Volatility becomes a weapon, and the market will use it against you. And that brings us to the viewer psychology shield. Because if you don't understand how volatility manipulates your brain, you will become liquidity for someone else. Volatility has a script. First, it gives you a story. It's over. It was a bubble. The government will stop it. The exchange changed the rules. Then it gives you a candle, a violent downwick that triggers panic. Then it gives you a fake relief bounce that makes you feel stupid if you didn't sell the bottom. And right when you re-enter emotionally, it does it again. This is how the market harvests weak hands without ever changing the underlying trend. So you need a simple framework to stay sane. Trend signal versus noise. Trend signal is structure. Trend signal is whether key levels hold on a closing basis, not on an intraday wick. Trend signal is whether the curve and spreads stay tight. Trend signal is whether dips are met with immediate demand or with vacuum. Noise is the headline. Noise is the intraday spike caused by margin, rumor, or a single forced liquidation. Noise is the emotional narrative that tries to make you trade your identity. And you must decide ahead of time which person you are. Because if you are trying to trade silver like a meme coin, you will get eaten. Silver is too big to be purely emotional and too levered to be forgiving. It will whip around violently even if your thesis is correct. Read that again. Your thesis can be correct, and price can still punch you in the face for days. So risk framing is not optional. It's the difference between being right and being paid. Now, let's ground this into what comes next, because the payoff of this video is not wow, crazy story. The payoff is a roadmap. For the next 1 to 2 weeks, there are only 2 scenarios that matter. Everything else is noise dressed up as analysis. Scenario 1, controlled pullback and retest. In this scenario, silver cools, not because the story is dead, but because leverage needs to reset. You get a pullback toward obvious technical zones, round numbers, prior breakout areas, prior consolidation shelves. Price can even wick below them intraday. But the key is the retest behavior. Do buyers show up quickly and do spreads stay tight? If this is a healthy reset, you'll see the selling slow as it approaches prior demand zones. You'll see bounces that don't look desperate, but steady. You'll see the market refuse to offer easy inventory. And you'll see the curve remain relatively firm, so meaning immediate supply is not suddenly abundant. In this scenario, the confirmation signal is boring but powerful. Dip buying that's not euphoric, just persistent. And the invalidation signal is also clear. If price breaks below the retest zone and stays there on a closing basis, and if the structure loosens, meaning the market starts rewarding future delivery more than spot, you're looking at a deeper unwind. But that's not the part that matters. The part that matters is this. A controlled retest sets up the second scenario with more force because it rebuilds the base while keeping the story intact. Scenario 2, continuation squeeze and gap risk. In this scenario, the market doesn't give you the gentle pullback. It stays tight. Dips get bought instantly. Shorts can't breathe. Dealers hedge. And the calendar becomes the catalyst. Thin liquidity sessions, overnight gaps, and forced buying. This is where silver behaves like a trapped door, except upward. Moves happen when you're not looking. The market skips levels. And the people waiting for the perfect entry watch price run without them. The confirmation signals here are not just price up. Price can be up for stupid reasons. The confirmation is structure screaming, tight spreads, nervous funding, continued physical tightness indicators, and positioning behavior that suggests forced cover. And the invalidation? It's a failure at a key psychological level coupled with structural loosening. If price slams into resistance, fails repeatedly, and then the curve relaxes and the bid disappears, the squeeze is pausing. Not forever, but pausing. Now here's the practical what to watch next week checklist, because you need something you can actually use. First, watch the plumbing headlines and the quiet plumbing numbers. SRF usage and reverse repo flows are not entertainment, but they are tells. If year-end stress fades fast, it removes one accelerant. If it lingers, volatility stays elevated. Second, watch overnight rate behavior. If SOFR and general collateral repo rates act jumpy, that's stress at the margin. And stress at the margin makes leverage trades fragile. Third, watch for any credible updates around export friction and industrial procurement behavior. You don't need to believe every rumor. You just need to see whether manufacturers start talking like availability matters. Fourth, watch the structure of silver itself, not just spot. If you can only watch one thing, watch whether the market acts like it wants metal now. If near-term tightness persists while price gets smacked, that's your tell that the paper slam didn't solve the problem. Fifth, watch the behavior of dips around the obvious zones. Silver is too volatile for you to pretend you can nail the bottom, so stop trying. Instead, watch whether the market respects key shelves and closes. That is the difference between a reset and a reversal. And here's the quiet warning, because this is where most retail gets emotionally exploited. Volatility will be used against you, not as a moral attack, as a mechanical one. If price is trending higher, but leverage is extreme, the market needs to shake people out. If too many people are leaning one way, it needs to punish that leaning. That's how it finds balance. And the punishment is never gentle. It's always timed. It shows up when liquidity is thin and your emotions are thick. So don't let a single candle rewrite your thesis. Don't let a headline force you into a time horizon you didn't choose. And don't confuse "I feel scared" with "the setup broke." If you want a simple defense, here it is. Decide your invalidation before price moves. Decide the level or condition that proves you wrong. Not a vibe, not a feeling, a condition. For example, if your thesis is tight physical market supports higher prices, your invalidation isn't price dipped. Your invalidation is price broke key support on closes and structure loosened at the same time. That's a condition. And conditions are how professionals stay sane. Now, let's address the word manipulation one more time, because you titled it that way, and the audience you're speaking to already suspects it. If you mean a coordinated illegal plot, you cannot prove that from price action alone, and you shouldn't pretend you can. But if you mean the system produces suppression-like outcomes because of incentives, then yes, there is something very real to talk about. When a market is heavily paper traded, the marginal price can be set by leveraged flows, not by physical reality. That's not a crime, that's design. When exchanges can change margin requirements, the marginal trader can be forced to liquidate. That's not a conspiracy, that's risk management. When dealers hedge options exposure, they can become forced buyers into strength and forced sellers into weakness, amplifying moves. That's not a secret, that's gamma. When funding costs rise, basis trades, and leveraged longs can unwind, smashing price even if fundamentals didn't change. That's not manipulation, that's plumbing. So the exposure is not a smoking gun. The exposure is the mechanism. Spot is not the full story. Spreads are the story, and the calendar is the trigger. And that's where the real pressure starts. Now, let's tie this back to the opening promise. What breaks if the wrong thing happens? If liquidity normalizes quickly, and if the export fear narrative fades, and if silver fails to hold its key retest zones on closes while structure loosens, the market can spend time digesting and mean reverting. That doesn't mean the long-term story is dead. It means the next leg is delayed. But if liquidity stays edgy, if industrial procurement remains anxious, and if structure stays tight, then the most dangerous thing for skeptics is not a straight-line rally. It's a rally that refuses to give clean pullbacks, because that's how squeeze markets work. They don't pay your patience. They punish it. So here's the final reframe I want you to leave with. Stop asking, is silver manipulated? Start asking, where is price discovery actually happening right now? Paper leverage or physical schedule? Because if physical schedule is tightening, paper can only delay. not deny. It can create wicks, it can create fear, it can create fake breakdowns, but it can't print metal. And if you're the kind of investor who wants to survive this market, you don't need to predict every tick. You need to track the right signals and refuse to be emotionally drafted into someone else's trade. If you're still here, you're not trading headlines, you're tracking structure, and that identity is rare. So here's your subtle CTA, not as begging as a filter. In the comments, tell me which single signal you want, tracked first next week, SRF usage and funding stress, silver term, structure, tightness, or China flow indicators, and I'll build the next breakdown around the signal that the structure first crowd chooses. Because when the market gets loud, the edge belongs to the people who can stay quiet, watch the spreads, and let the math speak.